Today, we're tackling a massive question that's shaking the Indian economy. We're talking about the rupee, which just crossed a historic line. But what does that number on a screen actually mean for the country, for investors, for everyone? Well, let's get into it.
So, for the very first time in history, the Indian rupee has fallen past the 90 to the dollar mark. And look, this isn't just another tick on the chart. It's a huge psychological barrier. Breaking through it, well, it sends a really powerful signal to the markets. It suggests the confidence in India's whole economic story might be starting to wobble.
And this quote right here, it really gets to the heart of the matter. This whole situation, it's not about politics. It's about raw, powerful market forces. You can try to talk up the market, but the market is ruthless. It doesn't listen to speeches, it listens to data. And right now, the data is telling a pretty worrying story.
Okay, so let's put on our detective hats for a minute and just follow the money. We've got 3 key pieces of evidence that are going to show us exactly why the rupee is under so much pressure. All right, our first clue is this number, 1.5 lakh crore rupees. Now, for anyone not familiar, a lakh crore is, well, it's a massive number. We're talking about 1.5 followed by 12 zeros. It is a truly staggering amount of money. But the real question is, where did it all go? That number translates to about 18 billion US dollars. And that's the amount of money foreign investors have pulled out of India this year alone. So you might hear an official story that India is a safe and stable place to invest, but the people with the actual money are doing something completely different. They are, as they say, voting with their feet, and that signals they're worried about what's really happening on the ground.
Now for our second clue, which is, believe it or not, even bigger. $41.68 billion. Just let that sink in for a second. That's about the size of the entire economy of a small country, and it represents a massive trade imbalance for India in just 1 month.
Yeah, the trade deficit, that's the gap between what a country imports and what it exports. It hit a record high in October. And here's the part that really makes you think. The big festival season in India is, well, it's Indian. So why on earth was the country buying so many foreign goods? It's a huge red flag for the whole Make in India initiative. It kind of suggests it isn't even meeting demand at home.
And that brings us to our final piece of evidence, negative 12%. A drop this sharp tells us that a really critical engine of India's economy, its ability to sell stuff to the rest of the world, is seriously sputtering.
So India's exports actually fell by 12% in October compared to the year before. And this wasn't just some random dip. This happened 7 months after new international tariffs came in, which means there was plenty of time to adapt, to find new customers. A drop like this suggests that maybe Indian products just aren't competitive enough, either on quality or price, to win on the world stage. So let's recap. We've got capital fleeing the country, a record-breaking trade deficit, and exports that are in a free fall. Any one of these is a problem. But when you put them all together, well, you get a perfect economic storm. And you can see exactly how these forces combine to create this pressure. You've got capital flowing out, which means fewer people want to buy rupees. You've got a huge trade deficit, which means India is constantly selling rupees to buy dollars to pay for imports. And then you've got falling exports, which means fewer dollars are coming in the first place. It is a triple whammy, and it's all pushing the rupee's value down, down, down. So what does this actually mean in the real world? Well, for a big company working on a slim 3 or 4% profit margin, a 5% drop in the rupee can completely wipe out its entire net profit. Gone. And for the country as a whole, every billion-dollar loan suddenly costs an extra 500 crore rupees to pay back. That's tax money that should be going to schools and roads, now just servicing debt.
But here's the thing. All these numbers, the capital fly, the trade deficit, they're just the symptoms. To really get what's going on, our investigation has to go deeper. We have to look at the root cause, which seems to be a fundamental crisis of confidence in India's whole economic policy environment.
So what's driving this crisis of faith? The diagnosis points to 4 really deep-rooted issues. First, there's the Inspector Raj. That's the old system of excessive rules and corruption that just makes it easier for a small business to import something rather than deal with the headache of making it. Then you've got bureaucratic hurdles slowing everything down, poor corporate governance that erodes trust, and finally, a commodity mindset, where the country is stuck selling low-margin raw materials instead of high-value finished products. But hang on a second. You might be thinking, if confidence is so low, why does the stock market keep hitting new highs? It seems like a total contradiction, right? Well, there's actually a pretty simple explanation. The reason is that the rising market is, well, it's misleading. Think of it this way. There's a flood of new money coming in from things like mutual funds, and it's all being funneled into a tiny handful of the biggest, safest companies. So this huge demand drives up their stock prices, which makes the whole index look great. But it's like a few giant trees growing super tall while the rest of the forest is struggling. It's a sign of capital concentration, not a sign that the wider economy is healthy.
So the diagnosis seems pretty clear. The big question then becomes, what's the prescription? What are the steps that need to be taken to actually cure the ailing rupee? Okay, the first steps are basically economic first aid. To stop the bleeding, policymakers have to get out there and calm the markets with a clear, consistent message. Then they need to use foreign exchange reserves strategically, not to just artificially prop up the rupee, but to smooth out the really wild swings. And finally, they need to create special windows to help serious foreign investment cut through all that red tape.
But the long-term cure? That requires much deeper surgery on the economy itself. It means finally getting serious about dismantling the inspectorage with a real crackdown on corruption. It means a national shift away from selling cheap commodities to producing high-value, innovative exports. And it means reforming the bureaucracy so that big, important projects can actually get done on time and on budget. And looking ahead, the pressure probably isn't going to ease up anytime soon. With government spending expected to rise and importers continuing to buy up dollars to protect themselves, the rupee could even hit 92 by the end of the financial year. So I think the most important takeaway from all of this is that fixing the rupee slide isn't about political speeches or quick fixes. It's about taking credible, coordinated actions that are backed by real data. That's the only thing that can genuinely rebuild the market's confidence. And that leaves us with one final, crucial question. The economic diagnosis is clear. A prescription for both short-term and long-term recovery has been written out. But is there the political and administrative will to actually administer the cure? That, I suppose, remains the 90 or perhaps even 92 rupee question.